Equities have been outperforming expectations on the year due to artificial intelligence excitement and rate cut expectations. Even though it seems like U.S. equities can't be stopped right now, your portfolio may be still at risk if it's not diversified. So what is it about hedge funds that could potentially protect you from equity downturns? We're going to break it all down for you right here on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you for being with us today. My guests are two members of the Chief Investment Office team, Sean Sanborn and Dan Scansaroli. Gentlemen, good to have you here. The conversation around hedge funds is not new for us. Dan, you've certainly been in the studio with me many times to talk about alternative investment side of the house, including hedge funds. But I want you to talk about hedge funds, especially historically, how they've performed, particularly at the levels of equity evaluations that we are now. And I guess, how they've been able to outperform given the way the markets have been for quite some time now.
It's the key question right now, especially as we've seen those equity valuations that are, they're close to about a 25 times multiple on their earnings, right? That price to earnings ratio. And that's historically in the top decile of what we've seen in terms of valuations. Now, to be clear, high valuations don't directly correlate in the short term to equity market performance, right? As we've seen, you mentioned the momentum that we've seen within the equity market. That exuberance can last for months or even possibly even years until there is a correction back to the fundamentals. And that's really what we're looking at here when we're looking at the hedge funds. Hedge funds over the long term, on average, during normal markets, when we've seen valuations more reasonably priced around a 15 to a 20 times multiple, hedge funds have about a 50% chance of outperforming the equity market. They are not designed to beat the equity market. Mm-hmm. They are designed to diversify your portfolio with a low correlated asset class that finds unique opportunities in terms of long-short opportunities, relative value opportunities, changes in the fundamentals of the economy that ultimately are hard to access in a public equity or a fixed income investment. And so when we look at hedge funds, they typically have performance in between stocks and bonds, with about a third of the volatility of the equity market. And that volatility is somewhere equivalent of what we see for investment-grade corporate bonds, mm-hmm. usually with about a little higher return and very low correlations. But in the environment that we're in right now, where valuations are 25 times, what we find when we look over the last 35 years at the data is that hedge funds have a much higher probability of outperforming, a much more predictive power over a 3 to 5 or even a 10-year basis, depending on the investment horizon of your portfolio, to actually beat equities, something that they're not traditionally designed to do. And part of that is because we do have a lower hurdle rate with a 25 times multiple on the S&P 500. If you look historically, that's typically corresponded 5 or 10 years out to a 5 to 6% return, not the 9 to 11% return we've seen in the last decade, annualized. But also, when we see valuations that high, we tend to see the volatility increase in the market at some point over the next 3 to 5 years. We tend to see that there's more dispersion, which brings that opportunity between the winners and losers for the hedge funds to net those risks and generate outsized returns. And what we find is that at a 20 times PE, hedge funds become quite competitive to equities. And at a 25 times PE, where we are currently, we find that historically they've outperformed anywhere from 3 to 4%. With about a 70% hit rate instead of the traditional 50% hit rate that you've had. Now we're talking about long-term investments, and they're doing that with a lot less volatility, much more efficient, because they are able to capture those risk dislocations. Mm-hmm. And that could be because of an economic slowdown, it could be because of an economic crash, it could be because the equity markets just revalue. It doesn't necessarily mean there's anything wrong in the equity markets.
Right. Thank you, Dan. And I think for a lot of folks who get sort of, there's probably people watching the show today who are familiar with hedge funds and maybe some that aren't as familiar. I think, you just have to break it down. The word hedge is in there for a reason. So like you said, it can be a hedge against volatility. And, the performance that we've seen historically has been pretty strong compared to the ups and downs we see in the vols that we see on the equity side and in the bond side. So Sean, let me ask you, because certainly you can't get away from having a conversation about the markets without talking about inflation. And we've certainly been in a pretty strong inflationary period for, quite some time now. And it's been pretty sticky for longer than probably most of us expected. Even though it's starting to come down a little bit now, and we expect the Fed is going to cut rates towards the end of the year. Talk about how hedge funds have tended to perform in these inflationary periods, and maybe why you could talk about CIO's view on why we think that hedge funds right now, considering where we are with inflation, is still a good idea.
Well, I think a good point that you mentioned there is kind of what we've seen from the economic data so far, at least in these past couple months, is that kind of the Goldilocks scenario has kind of come off the table. And that's tends to be kind of a period where an allocation of hedge funds is less preferable. So now we're kind of seeing moderating growth and moderating inflation. Right before I came in here, I saw that like the U.S. existing home sales reached their kind of slowest pace since 2010, which kind of goes in line with kind of what we're seeing in kind of our view on slowing inflation. But we still kind of expect inflation to be above a kind of its long-term average that we've seen over the past 35 years. So when looking at kind of that average inflation of around 2.6 over the long term, we do see pretty noticeable hedge fund outperformance against both equities and bonds. I think conversely, and a very important thing to talk about is, the low inflation kind of period that we saw during kind of the post-global financial crisis, where central banks were really suppressing volatility through quantitative easing. That was a very difficult period for hedge funds. And really the only ones that performed well were those that were kind of taking more higher beta trades and exposures, which is something you could much easier get in your kind of more passive index funds. And we don't really expect that to be the case in the near term. I think the Fed funds rate through mid-2018 is supposed to be around 4.7%. So we expect rates to be higher for longer, and that kind of creates direct tailwinds for most hedge fund strategies, both from a structural side, where there's specific strategies that have kind of increases on their cash balances, some that are either have kind of low margin requirements that kind of just have higher unencumbered cash balances, as well as credit and equity shorts just getting more kind of from their lendings. There's also kind of strategy specific benefits that you can get as well. Credit managers tend to be, especially on the fundamental side, tend to be kind of have a long credit bias, and they get just a pickup in yield from the higher rates. There tends to be higher macro momentum, as well as kind of just increased spreads on more arbitrage strategies. Think of like merger arbitrage and convertible arbitrage. As well as kind of higher default rates, which just lends itself to more opportunities for distressed and credit managers. So when we look at kind of just higher yields, looking at kind of the 10-year treasury with kind of a break even of 2%, but as rates tend to increase, we do see most hedge fund strategies outperform.
Yeah, and that chart that we had up a minute ago showing that rolling 5-year returns, and you could see that, hedge funds have outpaced, when it's above average inflation, both equities and bonds, and it still outpaces even below average inflation, it outpaces bonds. So it's such an interesting story, and you could just look at the averages, like you were talking about earlier, Dan, that there is, look, we can't say it's right for every portfolio. Everybody has different risk profiles and time horizons, but something that should be considered. So let me go back to you, Dan, because flipping from the inflation side of the story to the geopolitical uncertainty, you can't get away from the headlines these days, whether it's happening in the Middle East or it's happening in Ukraine and Russia. There's elections all over the globe, including all the recent news changes that are happening here in the U.S. election with just 3.5 months left to go. So the question there with hedge funds is, how are we looking to allocate in the context of all this geopolitical and election uncertainty that's happening around the world?
Yes, and uncertainty is a key
And does it matter is the question.
Yeah, it actually does. We have to be careful on how we parse that message in terms of how it matters, though. Because, as an example there, we're going through this unprecedented time with the U.S. elections, with Biden dropping out. Kamala Harris is being the presumptive nominee for the Democratic nomination at the end of August, so forth and so on. There's a lot of uncertainty in elections. There's uncertainty around who's going to be elected. And then obviously, as you mentioned, we have those geopolitical conflicts. As it relates to elections, it is very difficult to check our biases relative to our party allegiances and whether or not we have a positive outlook in terms of what could happen with the economy. And outside of that, to start off, when we look at the data, whether you look at hedge funds or you look at the equity market, whether you have the red or the blue party in charge, during their tenure when they are in the House, or whether they're in the presidency, the performance of the equity or hedge fund markets are generally fairly comparable. There's no statistical difference between them, and that is definitely true for hedge funds as well as equities. And I bring that up because there's other factors that drive in the economy in terms of what the equity performance and what the opportunity sets typically look like. But it is a factor in terms of those uncertainties. And so, as Sean mentioned, one of the biggest uncertainties that we are monitoring is around the path of the Federal Reserve. Are they going to pull off that soft landing? Are they going to cause an economic crash? The data is evolving in a way where, as he mentioned, we're not seeing that Goldilocks situation evolve, but we're also not seeing the economic crash situation likely to evolve in the short term. And as we look at that, that actually leans us, as we lean away from the Goldilocks situation, it leans us much towards hedge funds having a likelihood to outperform. But one of the biggest reasons for that is because as the uncertainty around the escalation between Russia and their war in Ukraine continues to have the potential to spill over, we have the negotiations of Israel and Hamas continuing with escalations in their fighting. We also have both political parties supporting policy of different degrees of trade tariffs against China. All of this adds economic uncertainty, commodity supply chain uncertainties. And those factors, when we see volatility increase, even volatility around the Fed's moves, all of those tend to be constructive for hedge funds outperforming, particularly the lower correlated hedge fund strategies, the strategies that play in commodities, in currencies, and play in different credit opportunities, as well as economic trends, which are macro hedge fund managers and relative value hedge fund managers. Those are the lowest correlated strategies that you can incorporate into your portfolio, and they seize on as a hedge against those downside risks to typically capture less than 20% of the equity market down moves. And if those down moves are not strong, they are typically zigging and zagging relative to the equity market to offset those. So about 50% of the up market capture happens for the average hedge fund relative to the equity markets, and usually on average about 30%. But going into the discretionary macro as well as the relative value managers, we see the opportunity to seize on higher volatility to hedge those downside risks.
Great, thank you, Dan. And so, Sean, I know we're almost out of time, but I wanted to ask you, because people look at, when they're looking at their portfolio, for so many decades, it's been the traditional 60-40 split, your allocation to equities versus your allocation to fixed income. But now, hedge funds, we think, should be playing a role in some of these portfolios. So how do you kind of expect that modest allocation shift to affect the traditional 60-40, and where does that fit? How does it work?
So if you take kind of a 10% allocation to hedge funds from a 60-40 portfolio, evenly sourced from equities and fixed income, so a 55-35-10 allocation, you have a pretty noticeable pickup in risk-adjusted returns from 0.63 to 0.67 when looking at a Sharpe ratio with a risk-free rate of 2.5%. And that is both a increase in returns as well as a dampening of your overall kind of portfolio volatility, as well as with lower drawdowns. And that's pretty important, I think, in this current environment where we see equity bond rolling correlations still modestly positive, and you're seeing kind of uncorrelated return streams from hedge funds performing pretty well. This year and the past kind of 12 months has been a pretty good example where equities have outperformed hedge funds, but hedge funds have significantly outperformed bonds, but when you look at kind of what Dan said, there's been a noticeable kind of lower volatility from hedge funds. It's been about a third of the overall volatility of global equities, and they're still performing about and returning about 50% of the overall returns. That's when looking at the index, and it's pretty similar as well when you're looking at a median hedge fund as well, so something you'd actually be getting with your kind of overall allocation. So for at least the past year has been a pretty good example of showing that hedge funds have been able to kind of provide pretty strong uncorrelated returns. And we expect that as volatility should expand and dispersion should increase across most asset classes.
Excellent. Sean, thank you very much. Thanks, guys. Always interesting and educational. And, when we're talking about hedge funds, it's a part of the market that people maybe are a little less familiar with. So it's good to at least have this when they go in to have these conversations with their financial advisors, find out if it's right for them, but have a little bit of the armor they need to have an informed conversation. Thanks. Good to see you both. Sean Sanborn, Dan Scansaroli. Thanks, guys. Good stuff.
Thank you.
Great. We'll see you soon. And there's a lot more information on this topic and many others coming out of the Chief Investment Office on our Insights website. The address is ubs.com/views. It's right there on your screen. Plus, you can follow us on all the social media platforms, including LinkedIn, Facebook, and Twitter. Plus, on Instagram, follow us at UBS Trending is the channel there for more content from the studio. And we say always, please make sure you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.